Welcome to Aspire's bite-sized overview on relocation expenses. Before we get on with the detail, here's an overview of the legislation. Under section 272 paragraph 1 of the Income Tax, Earnings and Pensions Act 2003, removal expenses incurred or benefits provided by the employer may be exempt from tax and national insurance contributions. The exemption is available to employees who change residence as a result of starting a new job or as a result of a transfer within an employer's organisation. There is tax relief for the first £8,000 of removal expenses and benefits which qualify for the exemption. To qualify, removal expenses and benefits must fall within specific categories, and the change of residence must satisfy a number of conditions. The most important of those conditions is that the employee must change their only or main residence as a result of starting a new employment, or a change of the duties of the employment, or changing the place where the duties are usually performed. It's not necessary for the employee to dispose of the main residence in order to qualify for relief, but there must be a change of their main residence. If a relocation is cancelled so that the employee does not ultimately change the main residence, any expenses reimbursed or benefits given in connection with the cancelled relocation will become taxable. The new residence must be within reasonable daily travelling distance of the new normal place of work. Well, what is reasonable daily travel is not specified in law, but it could be up to an hour or 90 minutes, depending on locations and the mode of travel used. The old residence must not be within reasonable daily travelling distance of the new normal place of work. To qualify for relief, removal expenses must be incurred or the benefits provided before the end of the tax year following the one in which the employee starts the new job. It doesn't matter when the employee moved to the new residence. Here's an example. Jim starts his new job as a sales engineer for a firm in Stevenage on the 10th of February 2018. He puts his old residence in Felixstowe up for sale in March 2018 and completes on the purchase of his new residence in Hitchin in February 2019. As the expenses incurred for the sale and acquisition of both residences were incurred before the 5th of April 2019, they are fully allowable. However, if the purchase of Jim's new residence wasn't completed until May 2019, only expenses incurred before the 5th of April 2019 would be allowable. Expenses and benefits which qualify for exemption can be grouped into following categories: disposal or intended disposal of old residence, including legal fees, mortgage redemption penalties, estate agent fees, and the disconnection of utilities. If the residence is left empty awaiting completion of the sale, insurance on the property, maintenance security are also allowable, but not the cost of any council tax. With regard to the acquisition or intended acquisition of a new residence, following items are allowable: legal fees, mortgage arrangement fees, mortgage indemnity premiums, stamp duty, survey and land registry fees, the connection of utilities, and of course the removal costs. Travelling and subsistence is also allowable for the exemption, and this includes the cost of initial visits to the new location, and travel and subsistence between the old residence and new work location. Travel and subsistence also between the new residence and old work location, where work takes place before transfer, and also between the old and new residences when the actual move takes place. Relief is also allowable for the travel and subsistence relating to the preliminary visit to the new location of the employee's family and their travel between the old and new residences when the move takes place. Where children stay in the old location or are sent ahead to the new location for education, their travel and subsistence is also allowable. Also, there's relief available for purchase of domestic goods for the new residents to replace those at the old one which are not suitable to be moved, such as fitted ovens, hobs, carpets and fitted white goods. And also where a bridging loan has had to be taken out, this is also allowable where the interest in the old residence has been disposed of and the interest in the new residence is acquired. The bridging loan has to be taken out to bridge the gap between the date when the new residence is acquired and the date when the sale proceeds of the old residence are available. Now on to the subject of international relocations. Travel costs to and from the UK for the employee, spouse and family may also qualify for tax relief, subject to certain conditions being met. If these conditions are met, the travel costs are in addition to the 8,000 removals expenses relief. This is a complex area, so please do not hesitate to contact me for advice on international relocations. Looking again at temporary accommodation in the UK at the new location, the cost of temporary accommodation is allowable and counts towards the £8,000 limit. When the temporary accommodation is provided by the employer, the amount is the cost to the employer of hotel accommodation, but for self-contained accommodation, such as a flat or house, it's the benefit in kind assessable under the living accommodation legislation, which is detailed at section 97 of the Income Tax Earnings and Pensions Act 2003. And finally, where an employee uses the services of a relocation management company, the administration fees charged by the company are part of the costs to the employer of providing benefits for the employee and therefore qualify for relief. If you have any questions on any aspects of relocation, UK or international, don't hesitate to contact me on the phone number or email address shown.